Hello traders, welcome back to the Forex Gig where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we are going to be talking about the ultimate Bollinger Band trading course. This is a powerful indicator that has been a game changer for many traders. And today you will learn how to harness its full potential. We will start by exploring what the Bollinger Bands are and why they are so valuable in Forex trading. Then we'll dive deep into the practical aspects, how to set it up, interpret its signals and use them effectively in your trading strategy. You will also discover the advanced techniques that can take your trading to the next level, and as well as common mistakes to avoid whether you're a beginner or an experienced trader. This comprehensive guide will equip you with the knowledge to use the Bollinger Band like a pro. So stay tuned and stay with me until the end as each section builds upon the previous one, giving you a complete understanding of this tool. So by the time we are done, you would have a new edge in your trading arsenal. Let us start with the ultimate Bollinger Band trading course. We start by understanding what Bollinger Bands are. And Bollinger Bands are powerful technical analysis tools that gives you valuable insight into the market volatility. This is basically the Bollinger Band, and it was developed by John Bollinger in 1980. This band consists of three lines that move with price action on your chart. The middle line is typically, this blue middle line is typically your moving average, is your 20 period moving average. This line serves as the base for up and lower band, sorry, it acts as your band for the upper band and the lower band on this Bollinger Band chart. The outer bands are calculated by adding and subtracting multiple of the standard deviation from the middle band. By default, this multiples is a set of 2, but you can adjust this based on your trading preference. So this is basically the setup for your Bollinger Band, where the middle line is a simple moving average, 20 moving average. What makes the Bollinger Band so useful is ability to adapt to market condition. The volatility increase the band When the volatility increases, the band widens. This is typically what it means. And when the volatility shrinks, your band decreases. When the volatility increases, the band widens. When it shrinks, it means that volatility has reduced. You can think of the Bollinger Band as creating a channel around the price. When price move up the upward band, we might indicate that market becomes overbought. Conversely, when price approach the lower band, it signifies that it is being oversold, is an oversold condition. However, it is crucial to remember that touching or even breaking this band doesn't always guarantee a strong reversal. When price touch this band, it doesn't guarantee that it will reverse to the downside. This is what it means. So we have to understand the Bollinger Band. We have to give ourselves a framework to interpret price action using the Bollinger Band. They can help you identify potential breakouts, gauge trend strength and even spot potential reversal opportunities on the chart. As we move forward, you will see how these characteristics makes the Bollinger Band an individual tool for various trading strategies, especially when it comes to scalping in the forex market. Now let's see how we can make use of our Bollinger Band. Now that we understand what the Bollinger Band is, let's dive deep into how we can use them effectively in trading. We start by looking for the settings components and the calculation, then move on to the specific trading strategy. Now to make use of the setting, the standard setting for your Bollinger Band is a 20 period moving average. We use a simple moving average of 20 period. This is the standard. The middle band and the upper and the lower band set a two standard deviation of 2. This is basically what this 2 is all about. Then you can adjust the settings based on your trading style and the market you are trading. For instance, if you are scalping, you might want to use a shorter period like your 20, your 10 or your 14. Perhaps 1.5 deviation can be used for a tighter band. If you want to scalp, you can change this to 1.5, while you can change your length to either 10 or 14. This is basically what it means. These calculations for the Bollinger Band is straightforward. The middle band is simply your simple moving average. For the upper band, you add two times the standard deviation to the simple moving average. The lower band, you subtract two times the standard deviation from the simple moving average. Your chart software will do the calculations automatically. You don't need to worry about all these calculations, but understanding the math helps you to grasp why the band behave as it do. Now let's look at how we can use the Bollinger Band in trading. One common strategy is the Bollinger Band bouncing. This strategy assumes that price tends to return to the middle band. Price tends to return to the middle band. Meaning when price touches the lower band, assuming price touches the lower band, which considers as oversold, it suggests that a potential buying opportunity might come at that area. Then when price touches the upper band, it can signify that it is an overbought condition, indicating potential selling opportunities might arise. If price touch the upper band, it means that price can move to the downside, and when it touches the downside, it means that price can go to the upside. These are overbought and oversold condition. Another strategy is the Bollinger squeeze. This occurs when volatility decreases. When volatility decreases in the band, it forms a squeeze. Traders watch for squeeze as it often precedes a significant price move. The direction of the breakout can be confirmed by other indicators or price action. This is basically what it means. When price squeeze, the breakout, when price breaks out from that area, it typically signifies that price is going to that direction. You can see there is also another squeeze in this area. When the Bollinger Band squeeze and it all of a sudden breaks out, it means price can move to that direction. That's in an uptrend and in a downtrend. This is basically what it means. Remember, you can use the Bollinger Band for trend trading. In a strong upward movement or in a strong uptrend, price often fluctuates between the middle band and the upper band. As you can see, in a strong upward movement, you can see price is trading above the middle band and the upper band. You can see this is the area, while in a strong downward movement you will see price will trade between the middle band and the lower band. This is typically how to use it to identify strong trending situation. This helps you to stay in trend longer and avoid premature exits. Remember, when using Bollinger Band, while using Bollinger Bands are powerful, they shouldn't be used in isolation. We have to combine them with other indicators or price action analysis for more reliable signals. Now let's look at the advanced technique in trading the Bollinger Band. Now that we have grasped the basics of the Bollinger Band, let's explore some advanced techniques that can be used to trade to the next level. You can use these advanced techniques to enter a next level trading. This strategy will help you to extract even more value from this versatile indicator. One of the most powerful technique is the double Bollinger Band. This involves using two sets of Bollinger Band with different standard deviation. Typically, you use the two standard deviation alongside a set of one standard deviation band. This creates zones that can help you to better identify trends and potential reversals. So by adding another Bollinger Band to my strategy, it will help us to get an understanding. Not only that, we change the standard deviation to 1. When we change this to 1, it will help us understand better. So this is how we can combine two Bollinger Bands to our advantage. This creates zones that can help you to better identify trends. The area between 1 and 2 standard deviation on either side creates what is known as the buy zone. These areas at this area at the upside creates what is known as the buy zone, and the downside creates what is known as the sell zone. It can signal potential trading opportunity. Now, the space between one standard deviation band is considered a neutral zone. This area here is considered the neutral zone. This band is also often indicates consolidation. Another advanced technique is combining the Bollinger Band with other indicators. For instance, the relative strength indicator. We can combine this Bollinger Band with another indicator known as the relative strength index. Relative strength index, it can help us to spot overbought and oversold regions. It can be a strong selling signal when price touches the upper band. When price touches the upper band of the Bollinger Band, when it touches the upper band, and at the same time we spot the RSI is in an overbought zone. This can indicate that we are in a strong overbought zone and can signal a strong reversal to the downside, as we can see in this particular area where price touched the upper band and at the same time was in the overbought zone. This signals potential strong selling pressure coming in. The same with when price touches the lower band and is in a strong oversold position. As you can see, it is below 30, signaling an oversold position, potentially revealing price is going to trend to the upsides, signifying a strong uptrend. We can also make use of multi-time frames analysis. It is another powerful tool that we can use the Bollinger Band. We can use in addition to the Bollinger Band. By looking at the Bollinger Band on higher time frame, we can better sense the overall trend and key levels in the market. Let's use this for an example. When we look at this particular trend to the upside, we can see that on this higher time frame, the Bollinger Band is trending to the upside, is staying above the upper region, signifying an upper trend. Then when we go back to our lower time frame, at that particular area, we would better understand what is happening, and we know that we are just looking for buying opportunities, since from the higher time frame our Bollinger Band, our price is trading at the upper part of our Bollinger Band. This signifies that we are in a higher time frame region. We can also switch to the lower time frame like we did so to get better entries based on the higher time frame approach, the bigger picture, and we can capitalize on the short term price fluctuation. So we know that we are going to buy when price gets to the lower region and take it up to the upside. Lastly, we can consider using the Bollinger Band width as a standalone indicator. This measures the potential difference between the upper band and the lower band. When the bandwidth reaches a historical low, it often precise significant price it may it and it signifies significant price move. This can allow you to potential breakout opportunities across multiple time frame, and adding this Bollinger Band width would help us understand this concept. We add the Bollinger Band width. This is the Bollinger Band width. Adding the bandwidth. This is the Bollinger Band width. It will help us to further identify areas of significant price movement. When price has reached this bandwidth low, it signifies a gain in band low. It signifies a particular move is yet to occur. At this particular low in the Bollinger Band width band, when price gets to a low in this area, it signifies that there should be a particular presiding moves over in price action. This can signify a breakout opportunity over multiple assets. As you can see, this is basically when it reach this low, at this low in this area. and it signifies that there should be a particular breakout either to the upside or to the downside. By incorporating these advanced tools to your trading strategy, you can gain a deeper understanding of the market and potentially improve your trading timing and accuracy. Now let's look at some common mistakes while using the Bollinger Band. There are some common mistakes that we need to avoid. Even if the Bollinger Band is as powerful as they say it is, it can lead to some costly mistake if not used correctly. So let's go through some common mistakes to avoid to improve our trading results. One of the most frequent mistake is treating the Bollinger Band touch as an automatic buy or sell. You don't have to use a Bollinger Band outer touch as your buy and sell. You have to incorporate this with other signals. If price reach the upper or the lower band, this can indicate overbought or oversold condition, but it doesn't guarantee a reversal. A strong trend, price can walk this band for an extended period of time. Like you can see at this area, for a strong trend, price walked the upper part of this region for an extended period of time. If you had in mind that when price gets to this upper band, you will sell, you would have taken a loss in this area. So you do not treat this as a sole area for you to buy and sell. The outer bands cannot be treated as areas for buying and selling. Another area is ignoring overall market context. The Bollinger Band are mostly effective when used with conjunction with other forms of analysis. Failing to consider factors like support and resistance, overall trend and fundamental news can lead to poor trading decisions. So you have to always incorporate your support and resistance in terms of trading the market. And as we can see at this area in the market, this was a resistance area in the market on the chart, this particular high that I was finding it difficult to break out from. If we had come to this area when price eventually broke out and came to this area, if we had decided to sell because price was above this Bollinger Band, was trading in the upside of this Bollinger Band, we would have taken a massive loss. But coming to account that this was a previous resistance point that price broke and is retesting the newly formed support area, we will be looking for buying opportunities. So this is why we have to put in mind that we have to incorporate our resistance and support areas when making use of the Bollinger Band. Now the next mistake we need to avoid is overtrading. Another common mistake is to avoid overtrading. Not every Bollinger Band signal is worth trading. It is crucial to wait for high probability setups when multiple factors align. Trying to catch every minor fluctuation often leads to death by 1,000 cuts. So lastly, many traders neglect the importance of the middle band. The middle band can act as a dynamic support or resistance level and can be useful for trailing stops. So we can use the middle band as a support or resistance level, and we can also use it as an area to trail our stop loss to. So be beware of the common mistakes that you can refine your Bollinger Band strategy and use this indicator more effectively. When you know about these mistakes, you try as much as possible to avoid coming in contact with this mistake. Successful trading is as much as avoiding errors as it is about finding winning trades. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, do not forget to like, share and turn on your notification bell so that you wouldn't miss out on more trading tips and strategies. Thank you for watching and I will see you in the next video.